Hey, good evening, everybody. If you all can hear me, please don't mind type a one. Oh, great. Okay, can. Okay, now it's 7:30. I think. Okay. Hope you all have your dinner already. Okay, before I start, okay, there is some of you actually have asked me some of the question. Okay, regarding the financing thing. Maybe I just go to this. Okay. Okay. This is some of you ask me what's the interest rate, and okay, when you do the leverage on the insurance, okay, someone asked me the leverage insurance product, is it universal life? Okay, there is two type. Okay, one is called universal life. Okay, but universal life is mainly to leave a legacy behind. What do you mean by that? Is I put in one lump sum of money. If I pass on, I got one lump sum of money to give it to my family members. Okay, so that is called. So some of them will use it for legacy planning. That's I got one client. Okay, he's an ultra high net worth. So you buy a universal life, the premium is 5 million US dollars. Okay, but he have a sum assured of 20 million US dollars. So that means he told me he passed on, at least his son got 20 million US dollar. So he no need to worry about his son futures. Okay. So that is on universal to make, it's called a wealth creation. So how the rich become richer. And they do it even by, he told me he only come by 1 million premium, 1 million, the other 4 million is borrowed from the bank. Okay. So net he still make a 50 million gain if you were to pass on. Okay. So that's how the legacy, the second generation become even richer. Okay. But the other side is mainly for own retirement cash flow. Retirement cash flow we call a lifetime income plan. Okay. Lifetime income plan, there's several lifetime income plan actually in the market. Practically all insurance company have lifetime income plan. Practically all insurance company have. Okay. For example, Aviva, the My Life Income. Okay, Aviva My Life Income. Okay, but Aviva My Life Income, the current version is not attractive anymore. Okay, the previous version, which before August last year, is one of the best plan in the market. Okay, it's one of the best plan in the market. Okay, so that one is no, the current plan is of course cannot compete with that one. So that's My Life Income, but not all My Life lifetime income plan can leverage. Okay, not all. Although some of the banks don't want to take due to I don't know whatever reason. Okay, whatever some of the bank will take only for a period of time. Okay, we look at China Typing. China Typing last year, they also have a very good lifetime income plan. Okay, previously also they also revised down the returns already. So they also have lifetime income plan and they work with RHB Bank. Okay, I think the transaction, the volume is too good. Okay, until RHB and China Typing decided to stop the financing of the plan. Okay, so and there is no plan for them to restart financing anymore. Okay, I think both sides collected too much money. Okay, so this is lifetime. So it actually it also come and go in this aspect. Okay, the plan may be still around, but no more financing available because bank already take the threshold. So when come, then what about margin? Okay, the margin using stock side. Okay, margin buying stocks. Okay, okay, for that type of financing, you need to declare income. Okay, you need to have income. Okay, you need to have income. If not, you need to have asset to back because you need to borrow money. TDSR apply. So that one is for those that have income. Okay, if no income, they want you to have asset to back up the borrowing. Then next thing come to margin financing using a margin account to buy shares, to leverage or buy REITs. Okay, the intention is not for you to go for trading using leverage. Okay, the intention is not. If you want to do trading using leverage, you can go for CFD or this shorter term. But margin account mainly for people that want to have better dividend yield, better dividend payout. But of course, you need to take certain calculated risk. Okay, then that's how you can leverage. You can leverage up to 3.5 times, okay, for grade A stock. And I recommend you go for grade A stocks or grade S stocks. Don't go and look for grade B, grade C. Okay, that one is mainly more towards trading and the risk is definitely much higher. Okay, you can look for grade S, just go for the S category stocks. And that part is you no need to declare any income. Okay, you no need to declare income because that is purely investment. Okay, investment. So you can only leverage on how much money you put in. Okay, how much money you put in. So you put in the money, you leverage up, then you can buy the shares. So after you sold off the share, you can take back the money. Okay, it just as POEMS account. It just as this account come with however, the commission rate is definitely higher than Cash Plus account. Okay, Cash Plus account also got the margin facility. You can also use Cash Plus account to do that type of leverage rather than margin account. Okay, but the differences is Cash Plus account, the interest borrowing cost is higher. Okay, it is not 2.99%. Okay, it's not 2.99%. I think it's 6%. Okay, 6%. Although the commission is so low, it can be up to 0.08%, but you need to pay 6% for interest borrowing. So it may don't make sense for you to leverage to get dividend. Okay, but for margin account, the interest is lower. However, the commission is higher. How high is the commission? You can just go all the way to bottom. Okay, on this side, and this is the commission rate. Well, some of you ask me, what is the brokerage commission? It is 0.18%, minimum $25. US is 0.18, minimum 20. 0.18 for Hong Kong. Everything is 0.18. Okay, it's just the minimum is 20 or 25. Actually, it's worked out to be about around $25 Sing on currency aspect. Okay, around $25 Sing in this aspect. Okay, the normal cash management account that link to CDP is 0.28%. Okay, so you really need to weigh what you are looking for. Okay, then from there, then you decide what you should do about it. Okay, so this is one thing. Okay, towards the end, I'll also talk about what are the stocks you can look out for. Okay, what are the ETF you can look out for, especially Biden win, and I think the Democrat have control the Senate. Okay, yesterday got a protest. I think 4 people died. Okay, but that will indirectly resulted in a certain ETF, like clean energy ETF will be the thing that people will go to. But Biden is pro clean energy. Okay, so those oil related companies like ExxonMobil, Shell will be hit by this. Okay, we'll talk about that later. Let's just go straight to today module. Okay, we are going to talk about growth stocks. Okay, we're talking about growth stocks for today, and we are not looking at Singapore market. But some of you actually asked me about Singapore stocks. Okay, even asking me about unit trust. Okay, we'll talk about that later. When complete everything, we look at how can you package dividends and growth stock together as part of your portfolio, mainly for passive income, but at the same time have capital gain. Okay, so we look at what is the universe. I think this one everyone should be quite familiar with this table. Okay, it's in a LM cost note also. Okay, so we have talked about this. We're in a course we talk about actually value stocks. As I mentioned, value stocks. We're looking at Singapore market. Okay, we're mainly focused on Singapore market. We're looking at dividend growth, constant dividend growth, and a lot of things mainly is focused on the risk aspect. Okay, on the risk aspect, and you use margin account. We are also advocating the use margin to increase your dividend payout. So actually, you also look for value stocks to do that using margin. Okay, and I mentioned a growth stock. Mainly, you want to focus it into look for US market. Okay, there is many growth stocks in US market. Okay, as the market is very big. For US, we don't want to look for dividend paying stocks as there is a 30% withholding tax you need to pay. So if the dividend pay 4%, you less of 30%, okay, you only become what? Less than 3%. Okay, 3%, and it's in USD. So you also subject yourself to currency fluctuation. Now US dollar has started to come down. So it may convert to Sing dollar, your dividend yield is even lower. Okay, if US dollar go up, then maybe higher. So you also expose yourself. So we are not focusing on US market for dividend play. We're more focusing on growth play. It means more of a capital upside. Okay, and of course, it best you can have the in between. In between, mainly we are looking at Hong Kong and China market. Okay, China market. But the bad part about Hong Kong and China, the good part about Hong Kong and China market is Singapore time zone. Okay, it's Singapore time zone, and sometimes the company you may be more familiar with, because it is more related to us, also more near to us. The bad part is the capital outlay can be a lot more, Just like if you want to buy, for example, Guizhou Maotai, okay, Guizhou Maotai is considered China consumer growth stocks actually, okay. You want to buy Guizhou Maotai, you need more than 40,000 Sing dollar just to buy Guizhou Maotai. Okay, so it is out of reach for many retail investors. You want to buy BYD, you need just to buy a BYD, the minimum quantity, minimum purchase is $12,000, 12 to 15,000 Sing. Okay, 12 to 15,000 Sing. Okay, so there's a bad part about Hong Kong and China. Okay, some of the good stocks is really need high capital to invest. Okay, we'll talk about that later. Okay, so our focus will be on growth stocks aspect. Okay, so what is actually a growth stocks? Growth stock, we are looking at company that expect to grow. Okay, their business revenue is supposed to grow in double digit. Okay, the key thing for growth stock is always call. We are looking at what? Double digit. Okay, double digit in growth. Okay, double digit in growth. Their business growth. Their business growth in double digit, we also means that their profit, revenue, return, everything we are looking at double digit growth. Okay, the higher the better. More than 20%. Okay, grow. And the higher the better. So how are we going to look at this aspect? Okay, let me just go in. Okay, so when we analyze growth stock, what are the fundamental metrics we need to look at in? Okay, so this is the first part when you look at a growth stocks. Okay, first we want to look at revenue. Okay, the revenue must be growing. Okay, when you do dividend stock analysis, you also want to look at revenue growing. Okay, revenue growing, profit, which is actually the income. Okay, later we do some live stocks example. Okay, just to show you how to find all this information and how to analyze this information. And the profit must be also growing. Okay, and next is the asset also growing. Okay, especially when a company keep on growing and growing and growing, they will need to buy more asset. Okay, even a technology company, they need to buy more computer related things. So because the company is growing, so the asset will also be growing. Okay, the asset is growing. Cannot be revenue go up, profit go up, the asset don't grow on. Okay, the company need to expand. Need that. And we look at ROE, ROA, we need to look for double digit. Okay, double digit. As either higher the better. Sometimes people say that ask me, Darren, 10% is okay. It's up to your, of course, 10% we cannot say not okay. Okay, it's up to you, but we are looking at 15%. But sometimes you will see that the equity can grow very high, can be even 35%, but the asset may be 12%. Okay, so actually our key focus is for these two, okay, because you can't find a perfect match company. Okay, for the return equity, we still focus on equity return. As growth stocks, no matter what their asset, okay, will be definitely much lesser compared to those capital intensive company. Okay, those capital intensive company you see are not really on the growth sector. Okay, what are capital intensive company? Property company. Okay, property company is a capital intensive company. Okay, because they are very asset rich. So also for them very hard to grow their ROA also. Okay, so we are still focused on equity. The higher the growth is, of course, the ideal case is everything also grow in double digit. Okay, that is the most ideal case. Okay, so this is the first part we will look into it. Okay, the second portion, okay, we will look into it is all these financial ratios. Okay, This is just a revision. When it comes to value stock analysis, we still use the same revision. Like we still look at current ratio, we still look at debt to equity ratio, we should look at interest cover. But actually, this is just to give us a peace of mind that the company is financially sound. Okay. But usually, I sometimes I even skip this. I even skip this, as if the company is growing all these things. Usually, this is okay one. This data is okay. So this is just to give you a peace of mind, give everyone a peace of mind. Oh, the other ratio is there. Okay. So this is just some guidelines. Okay, when you look at the ratio the asset matrix expect. Okay, and we know that P. I have mentioned that P before. Okay, just a refresher. What does a P of 5 means to you? Okay, a P of 5 actually it means that when you want to invest in this company, it takes you 5 years to get back the money. Correct? So a P of 20 means it take you 20 years to give you back the money. The traditional way of analysis is how you see a lot of people type P 15. Anything less than 15 is called undervalue. Okay, undervalue. Anything more than 15 is called overvalue. That is a traditional way of looking at it. Okay, but as I mentioned a lot of time, don't focus on this to analyze the stocks, to read value stock or growth stock. Okay, it may get a wrong thing. Okay, a P is 5. It also tell you that the company may be on the verge of going bankruptcy. Okay, a low PE company can mean two things. It can be really undervalued. People never know about this company, but it also means that the company is suffering, making heavy losses, and they may go for insolvency also. Okay, in this aspect. Okay, why I say that? You look at P. How does a P being derived? Okay, it's price over earning. Okay, sometimes you see a price over earning there's dash. Okay, there's no number. So what does price? Okay, over earning. Earning is usually earning. We talk about earning per share. Okay, earning per shares. Okay, earning per shares. Okay, it is dash. What does that mean? Anyone know when you see when you see a company a PE, then they got no data one. They just put dash. So what does that mean? Okay, when you see a PE is dash, then it was only okay. Then yes, making losses. Correct. Muhua, correct. So when I see a P is dash means the company losing money. Okay, the earning per share is negative. Well, the price cannot go negative. Okay, no matter what, they still got price. It can go to penny stocks, but it go to negative. So negative P. So negative P is not practical to calculate. So it is dash. Okay. So we see zero is dash. But what about company is not, is still making money, but they are suffering already. So they are suffering already. So their price will keep on drop. Okay, the price will keep on drop. Okay, the price will keep on drop, and this one is fixed. Okay, because when their earnings drop, you see when the earnings drop, the price will drop faster. Okay, the earning drop, because when the earning drop means dividend will drop. Dividend will drop, price will drop faster. So your PE will also drop. So a low PE may indicate a company that's going to go for distress already. Okay, going to go for distress because of the earnings drop a lot and the price drop a lot. So don't go and look for just purely by looking at PE low means undervalue, PE high means overvalue. Okay, and PE you see is very good to look at index as a whole. Okay, broad market index as a whole. And if you really want to use P to compare a company, compare among the peer, compare within the sector. For example, property company, then look at all the property sectors. Okay, all the property sectors, Capital Land, Fraser Property, look at across the same sector. Then you compare what is the industrial average P. Okay, so that is what you want to focus. What is the average P for the industrial? And then from there, let's say the industrial average P for this sector is 20. And what about these stocks? Okay, these stocks, you look at the P, is 19. So it is below industrial average. Okay, it's below industrial average. then is it really undervalued? Then you need to go inside, look further in that case. Okay, but most of the time you see you buy stocks that's above industrial average, right? But that's are the better company now currently. That's how the market have changed over the time. So sometimes that all these are theory, and theory is derived in the past. Okay, in the past, but the economy has started to modelize and start to change, and now information moves so fast and you can compare to the past. So sometimes we really need to use the old things but tweak it to current practice. Okay, tweak it to current practice in this aspect. Okay, so for growth stocks, we want to be able to predict more accurately, so we are not going to look at PE. Okay, I'm going to introduce a new term called PEG. Okay, PEG, okay, is price to earning to growth. Okay, it's a price to earning to growth. What does that mean? Okay, it is talking about, okay, it's talking about actually share price. Okay, okay, it's talking about the price over earning, right? Over the growth rate. What growth rate we are talking about? Okay, what what is the price to earning to growth? Okay, it's the growth rate. What growth rate we are talking about? We are looking at earning growth, the earning per share growth. Okay, we want, if the company is a growth stocks, if the we are not looking at dividend growth. Okay, we are not interested to look at dividend growth as we are looking at growth stocks, because most of the time, most of the criteria of growth stocks is don't pay dividends or pay bare minimum dividends. Okay, what do my bare minimum dividends is? Your dividend yield may be not even 1%. Your dividend yield most of the time is less than 2%. Okay, less than 2%, or 1%, okay, 0.5%, okay, or even zero. But they are not interested to pay you dividend. Okay, they are more interested to the growth aspect. You just want to grow. Berkshire Hathaway don't pay you dividends, okay, but they are actually growing. Okay, so it's more of the, we are looking at share price appreciation. Okay, so if the earnings per share grow every year, okay, if the earning per share grow every year, you also will mean the share price will go up. The share price will go up. Okay, so we want to know that so that's how we calculate PEG. Okay, PEG is based on share price divided by the earning per share growth. Okay, then the next question is how to determine the growth rate of EPS. How to determine the growth rate of EPS. So that is a tough part on this aspect. Actually, I want to use Poems, but Poems don't have this calculation, don't have the earning growth rate on the stock analytics. Okay, so we're not going to find this earning growth rate. And if you really want to calculate earning growth rate, maybe just go. Let me just show you one example first. Okay. So let's look at this company called, okay, Apple. Okay, Apple definitely is belong to the growth stocks category. It is definitely not a dividend stocks category. So we look at, okay, I think no need me to introduce who is Apple. Okay, everyone should be aware of who is Apple. Okay, first you can see that their dividend yield, as I mentioned, dividend yield is very, very low. So when you buy Apple, you are not looking at dividends. And do think that this dividend yield is before the 30% withholding tax you need to pay. So if less off tax, I think you get even more miserable dividend. So we are not going to focus on the dividend. Even they tell this 3-year growth rate. This 3-year growth rate, you talk about dividend growth rate. Okay, so we are also not interested in this aspect. Okay, so what we want is we want to look at the, okay, the other three ratio like current ratio, debt to equity ratio, interest cover ratio is here. Okay, interest is here, is given. Okay, but when it comes to growth, we want to look at EPS growth. So how we look at EPS growth? You just need to go down. Okay, under the stock analytics portion. Okay, so you look at this is what do you mean by the EPS? Okay, EPS growth. You want to do a simple calculation. What you need to do is just take this Okay, take this to this. Okay, so this is the growth rate. The difference in percentage, that's called the growth rate. Okay, so that's called 1 year growth. Okay, the difference in percentage, okay, is called 1 year growth. Okay, if you want to do a longer term one, then what you need to do is a simple calculation. Simple calculation is this one is calculate percentage change. This one you just need to calculate percentage change. This one is the percentage change, and this is the percentage change, right? So what you need to do is you need to sum it up. Okay, sum it up and divided by 4. So this will call the average EPF growth over the past 5 years. Okay, this is because we do a simple math. No need to use a GP to calculate. Okay, so this is one way. So some of them would like to say, oh, I just like to take 1 year different, then I do the growth. Some of them say, oh, I got 5 year data, so I do the average of everything and sum it up. Sum it up to do the average. Okay, so you can see the average. This one to this one is positive, correct? This one to this one is also positive. This one to this one is negative. Okay, because actually it's dropped. But this one to this one is positive. So you sum it up will be positive. Okay, then you divide it by 4. And that is the growth rate. Okay, that is the average growth rate for the past 5 years. And that's how you calculate PEG. So what is the price? Okay, divided by the growth rate. And you will get the PEG. Okay, so this is how you calculate the PEG in this aspect. And if you are lazy to calculate, later I'll show you where to find a simplified way that calculate for you the PEG. Then you can use that, okay, to do that calculation. But if you really want to do some of them would like to see the number themselves, do the manual calculation. And you say that 4 years not good enough, you want to see 10 years data. Then Poems is not a place for you to see so long data. You need to go to other source to buy longer term data. But to me, 5 year is good enough. 5 year data is good enough as the market has evolved too fast, have changed too fast. Whatever you see 10 years ago is already outdated. Even 5 years ago is outdated. So some of them even only use 3 year data because they say 5 years is a bit too far, especially for growth stocks. Because the market is changing too fast, the environment is changing too fast. So they are not really looking at too long a data. Okay, so this is how you look at that. Okay, since we are in Apple, okay. Okay, later I show Morningstar have the growth rate or not. I didn't use Morningstar. Later I want to show you where I get the data first. Okay, you can go and check on Morningstar. Okay, so then this is where you can find the. Okay, so Poems also have limitation. So when it comes to growth stock analysis, Poem really have some limitation when you want to do analysis, but they at least give you some basic idea before you go further. Rather than go dig further, it's very from here you see that, okay, I know that this is Apple. So the current ratio, debt to equity ratio, interest cover, okay, is okay. It's okay. Then I look at what about their revenue. Okay, I talk about revenue growth, right? Okay, is the revenue growing? This is 215 billion. 229, 269, 260, 274. So definitely it's definitely growing. Okay, the revenue is definitely growing. But are they facing competition? Is their income growing? That's profit. Okay, go up, come down, go up, but it's still growing up. Okay, so in a nutshell, actually their revenue and income is growing up. What about the asset? Okay, so you go down, you look at their total asset. As what I mentioned about asset growth, right? 321, 375, 365, 336, 323. Actually, their asset didn't really grow. Okay, their asset didn't really grow. That actually their asset remains stagnant. Okay, remains stagnant, but their revenue and income is growing very fast. Okay, and their EPS in a nutshell is growing. Okay, it's growing, and thus we can easily to calculate. Okay, let me just go to this far. Okay, this is the far. Okay, that I sent to everyone. Okay, there's some error on the file. After this session, I'll send up an updated file. Okay, this one I put the typo error. This is we are talking about growth trend. Okay, we are talking about growth trend. Okay, I put valuation actually talking about revenue growth, asset growth, profit growth. Okay, and these three data we already have. Okay, and the return equity is 70%. Okay, for Apple. Okay, you can see the data here is actually 73%. Okay, as I mentioned, we want 15 or more, right? Look at their return equity for Apple is from 36%, okay, 36, 50, 55, 73. So even Steve Jobs have gone already. Yeah. Apple under Tim Cook still grow very well. Okay, you can see the return equity is almost increased by 100%, 36 to 73. Yeah. Okay, uh, which explain why Apple share price have went up so high. Okay, we explain why Apple share price have went up so high, and that's how when you look at growth stocks, you want to look at ROE double digit, the higher the better, and you want them to grow up in this aspect. Okay, if we reverse the way that if you see Apple, let's say 73 here, 55 here, 50 here, 36 here, 36 here, this is downtrend growth. So this type of stocks, you just need to be careful. Don't be happy with 36%. You have to look at it's come down from 73 one. Okay, it come down from 73. That means that then you need to understand why it come down from 73. Although it's still giving you double digit, okay, but is it coming down and it's going to be a stagnant? Okay, that's how a company go. They go through an exponential growth state. Then after they start to stabilize. Okay, so with it going to be stabilized soon? Okay, we going to stabilize. When it becomes stabilized, you are looking at dividend play already. And currently, if the dividend yield is too low, then you may not be interested anymore. Okay, so this is one thing. So you don't look at the number also. You also must look at the direction. Okay, so poems one thing good is give you the sense of how you feel the direction. Okay, but some of the data where to get it from, let me just go to this site. Okay, I use a site called Yahoo Finance. Okay, Yahoo Finance, I think it provides quite a very good data. Okay, let me just type Apple, APPL. Okay, and I click on this Yahoo Finance expect. Okay, one thing good about Yahoo Finance is, okay, I show you what is a good point first. Okay, when you go down, okay, now there's this thing called ESG. Okay, so people start to more and more looking at ESG already. So this one tell you the ESG score of Apple. Actually, okay, on Apple side 33%. Okay, and you give it their revenue. And one thing I like Yahoo Finance, you got bar chart. SGX last time, SGX no more longer have bar chart. You can push a bar chart to quarterly, annually. Okay, and you can play with the numbers. Okay, and also give you recommendation rating to buy, strong buy or hold. Okay, and target price by all the analysts. Okay, and this is an international company. How many analysts? How many analysts have look at Apple? 38 globally. There's 38 analysts. So this is the average price, okay, of all the analysts target. Okay, of the target price of analysts, and of course they give you the status, okay, and company profile. Do take note of this number. You even tell you how much a company employee that is 147,000. Okay. Later I share with you a company that only have 3 employees. Okay. But for those that buy that counter for 3 to 6 months ago, they have easy make more than 1,000%, I think. Okay. So there's a lot of different in this. So this is, and you have all this news about okay, of course there's some advertisement news, but I of course talk about articles, but a lot of them mainly from Motley Fool. Okay, talk about the Apple related is for your information to catch up with the news on Apple aspect. Okay, so this is how Yahoo Finance is. Okay, everyone able to come to Yahoo Finance. Okay, and if I'm going too fast, do let me know. Okay, do let me know. Then okay, cannot follow also do let me know. No need to do exercise. Okay, no exercise required. Okay, so when I want to do an analysis, let me just go straight to this Excel file. Okay, and we just go through it step by step. Okay, to do the analysis of Apple. Actually, this I forgot to change the. This is actually okay. Okay, okay. Let me just go and look at Apple. Okay, what is the market price for Apple? We know that the closing price for Apple actually yesterday have dropped 3%. Actually, yesterday all the Nasdaq stocks mainly have dropped quite a fair bit. Nvidia I think dropped 5%. Okay, 126.66. So that is the closing price for Apple yesterday. Okay, how do you still stock for analyze later? I'll talk about that later. Okay, I'll talk about that later. Practically just like how you choose Singapore stock, there's also 700 stocks in Singapore to buy. Okay, so key criteria also same thing. You want company that is big. So there's screener, like poems, you got stock screener, you can go and screen. Okay, let me just go to later I share you the poems. So we can screen out the stocks that you want. Then from there you go and look into for more details aspect. Okay, but you see the key rule is when you want to buy a stock, look at name that you are familiar with one. Okay, look at name that you're familiar. Don't go and buy stocks that you never heard before. Okay, so that's the first rule. Okay, so that's also called circle of competency. If the company never heard before one, that means it's definitely out of your touch, out of your range. So you never heard before. So then don't go and touch the stocks unless you go and study that company very well. That's something to start with. So when you look at growth stock, look at names that you are familiar with. Okay, familiar with like Apple. I think most people know what Apple do. Okay, and number two, big companies. Big companies. Okay, don't go for company that is too small. Okay, too small. How small is small? When I talk about small, we also talk about market cap. Market cap. When I talk about dividend stocks, as I mentioned for Singapore dividend stocks, I said that look at market cap that is 500 million and above, right? Okay, 500 million and above. Okay, that is talk about Singapore stocks. That's all. In US stocks, please don't go and look for 500 million and above. Okay, please don't look at practically, you look for 500 million above, practically find practically all the US stocks under this category. Even the penny stocks that only $3, $5, they are also in billions. So you can see Singapore market, US market is completely a different ball games. Okay, so it is really too small. What you want is company in billions. Okay, and Singapore we look at 500 million, right? Here you may want to look even at 500 billions. Okay, or 500 billion. Sometimes a lot of people say 500 billion be too hard. Then 100 billion at least it is a company that is big enough. Okay, you want company that is big, especially for the US market, as it's a global market. Every people in the world are trading at the US market. So you want company that is big, as everyone is trading in the US market. If the size is too small, even a 1 billion, 2 billion company, okay, the price can be easily manipulated. Okay, the price can be easily manipulated as 1 billion is small money for big player. Okay, 1 billion market cap is small money. They can swing the price up and down like nobody business. But if the company is 100 billion, 300 billion, 400 billion, 500 billion, it's very hard for people to manipulate the share price. Okay, very hard for there's a in the market there's SGX is very concerned about what is happening currently in Singapore market. That people start to form chat group to talk about stocks. Okay, SGX is very concerned about that. Okay, and because some of them form a chat group to create a syndicate in a way that to pump and dump stocks. Okay, so you want to not be inside this to get hit by the pump and dump group. Okay, so you want to look for market cap that is big. Okay, market cap that is big. So in Singapore we look at 500 million, but US you need to look at billions. Okay, 100 billions and above. So that is what we are looking at. Okay, and look for names that you know. Okay, first thing, look for names that you know. Okay. So actually it become actually quite straightforward to that. Okay, I'll talk about the list. Okay, so PE reading is given here, 38. Okay. Okay. PE reading is 38. Okay, 38.62. Okay. Earning per share is 3.28. Actually, they already calculate for you. Okay. So the P is 38.62. The EPS is 3.28. And then you can just put it here. Okay. 38.2, 3.28. Okay. So okay. Okay, so you can see that under here, okay, even at here you put a static. Okay, let's look at statistics. Okay, okay, look at statistics here, right? When it summary, you just give an overview of the company. So still we look at market cap, you see a big company. Okay, it's too small company, we are not interested. Okay, of course the P is just an indication for growth stock. You cannot look at 15 as I mentioned. You look at 15 now, then it's already out of range already. Okay, so the earning per share is $3.28. Okay, and the PEG actually is calculated here for you. Okay, PEG 5 years. Okay, they based on 5-year PEG is 2.49. Okay, so this is how a PEG is being calculated for you already. If you really want to don't like the PEG because they based on 5-year expected, but they didn't tell you what is the growth rate. They didn't give you the growth rate. So you want to know the growth rate, you can work backwards. Okay, you can work backwards for the PEG formulas. But let's say you don't want to take their given reading and you want to do your own growth rate calculation, by all means. Okay, by all means. And some of them will say that, oh, I don't like to take this reading. Okay, I don't like to take this PEG reading. I want to calculate the growth rate. So what growth rate should I use? Okay, you can go to this thing called analysis. Okay, analysis tab. Okay, this analysis tab tell you is taking the average of 30 analysts. Okay, number of analysts 30. Okay, for earning estimate. Okay, then we go all the way down to look at this thing called growth estimate. Okay, growth estimate for Apple. Okay, for Apple for the next 5 years, what is the analyst estimates of Apple growth for the next 5 years? 12.72%. So you can also take this as a EPS growth, because if the company were to grow, the revenue were to grow at 12.72%, the profit grow at 12.72%, indirectly the EPS will also go at this 12.72%, because all should go in the same tandem, all should go in the same line in there as well. So if you don't want to use what is calculated there, they want, I think they use writer to compute, but you want to use the average analyst estimate to calculate PEG, you can use this data 12.72. Okay, so that's what analysis is very interesting, is there is no right or wrong. There's not right or wrong data. Okay, but the key thing is it must be consistent. Okay, it must be consistent to get the data in this aspect. Okay, okay, so when you look at 12.72, let me just share with you. Okay, so you look at 12.72. Okay, so if I key 12.72 here, 12.72%, now PEG is 3.04. Okay, 3.04 here. Okay, so this is auto calculate for you. Okay, PEG is 3.74. Okay, so 3.04, what's a PEG mean? Okay, a PEG equals to 1. Okay, mean it is at fair value. Okay, a PEG equals to 1 means it is at fair value. Okay, a PEG less than 1, okay, is 0.5. Value investor will call it as undervalue. Okay, value investor will call it undervalue. A PEG more than 2, value investor will call it overvalue and they want to sell. okay, and they want to sell. Okay, but by looking at, so to them, value investor will say that Apple is very, very expensive. They will not want to buy because PEG is 3. Okay, PEG is 3, is very, very expensive. Even if they take what is being computed by writers here, okay, you go to the statistics here. The PEG is 2.49. It is still more than 2. Okay, so you were to talk of those that do value growth investor, they'll tell you Apple is very expensive. Wait for Apple price to drop, then buy. Okay, this is what they will tell you. Okay, this is what most value investors will tell you in this aspect. Okay, but this is just one methodology. But I feel that if you really want to compute Apple, then you may want to use another method. It's called discount cash flow method. Okay, discount cash flow method. Discount cash flow method will be maybe an even better way to calculate growth stocks. Okay, maybe even a more accurate way. Okay, so I just go back to here. So PEG is just an indication on this aspect. Okay, but I think it's too simple. It's too simple. Okay, if it's so simple, everyone will make a lot of money. Oh, PEG 0.5 buy, 2 sell. Okay, and then, but in that case, they will never buy Apple. They may never buy Apple. I think Apple PEG don't go below 2, except the much market downturn. Okay, so this is just an indication of that. Okay, and this is an illustration how you can use PEG to do a peer-to-peer comparison. For example, this is stocks A. This is $100. Okay, both are $100. Okay, earning per share is 5 and 10. So you can see P, this is 20, this is 10. Okay, so is that undervalue? Okay, is that undervalue? Okay, is that undervalue? But look at the earning growth rate. This is 20%, this is 5%. But I look at PEG, actually this is overvalue. Okay, this is overvalue because the growth is too low. Okay, so when you look at growth stocks, we are more focused on PEG. If you are someone that like to look at PE, then I will say that please look at PEG for growth stocks. Don't look at PE. Okay, but if someone don't even look at PE or PEG, then you may want to straight away jump to look at something called a discount cash flow method. Okay, a discount cash flow method. Okay, but do take note, as I always mentioned, like dividend discount model used to calculate for dividend stocks. Okay, discount cash flow methods is used to calculate growth stocks. Okay, so that is a two different set of model in that aspect. Okay, but do take note, there's always assumption when you use this mathematical model to do calculation. Okay, when this, so there's always assumption. So also means that your data input, if your data input is rubbish data, it will give you rubbish result. Okay, rubbish data will give you rubbish result. So that's something you need to take note. Okay, in this aspect. Okay, so what is the key assumption of a discount cash flow? Okay, a discount cash flow thing is first thing, dividend is no dividend. That means the company are not supposed to pay dividends. Okay, it's mainly for growth. So discount cash flow is very good to analyze Berkshire because they don't pay a single cent in dividend. Okay, but some companies still pay dividend or very low dividend because the dividend don't really impact too much on the company. Okay, don't impact too much on the company. So so too low dividend is okay, a very low dividend. Okay, that's what I call discount cash flow method. Okay, number 2 is the company must be profitable. Okay, must be profitable and must be grow. The profit must what? Grow. The profit must grow. So you are assuming the company will continue to grow. Okay, if you know that the company is going downhill, then discount cash flow don't work at all. Okay, the company must grow, must be profitable, first rule. Number 2, they must be growing. Okay, they must be growing for how long? 10 years. Okay, they must be growing for at least 10 years. Okay, so this is something, okay, something we need to take note. Okay, it must be growing for 10 years, and that's how discount cash flow must work in will work in the aspect. Okay, if the company is paying very high dividend, the payout ratio is very high, like 70%, 90%. Like ST Engineering, the dividend payout ratio is 90 over percent. You please don't use discount cash flow to analyze ST Engineering. Okay, you don't get any real thing come out of it. So you cannot use discount cash flow to analyze REITs. Okay, please don't use to analyze REITs. It also don't work for that sense. REITs, you need to use the dividend discount model. Okay, so these are the key part when look at it. Okay, so so how does a discount cash flow actually work? Is okay. It is a matter of valuation to use to determine the value of investment based on the return and future cash flow. Okay, that means I presume the company will able to generate money to have cash flow. Okay, for the next at least 10 years. 10 years. Okay, some people say 5 years cannot. You want to do 5 years, of course, also can. Okay, but we are looking at the growing concern. I'm not asking you to buy and do a short trading. You're looking at long term. So it's project they're able to grow at 10 years. Okay, then the challenge come already. How much should they grow in 10 years? Okay, nobody knows. Nobody knows how much. 10 years, some of them too fast. So there is this limitation in that. Okay, let me just go into what are the key things you need to look at. Okay, first thing you look at something called cash flow. So the company must have something called free cash flow. Free cash flow. And free cash flow is, what is free cash flow means? Means the company got money to move around. Okay. And actually, this is something also to take note. When you see a company have negative free cash flow, have a negative cash flow, it is a red flag. Do take note. When you see a company have a negative free cash flow, it is a red flag. Okay. Why Hyflux can go bust? Before Hyflux go bust, they have negative cash flow for years. Okay. If it's a negative cash flow for 1 quarter, okay, I think that one is okay. Okay, but it's a negative cash flow for years. SIA, before the COVID-19, already have negative cash flow for years. Okay, for years. Okay, so it is a red flag. Okay, it is a red flag. So do take note, the company don't have money, man. They are taking what future money to roll the money only. That's why they are negative. They just keep on rolling. They don't really have money left. Okay, so you want to look at free cash flow. So how does it compute it from the operating activities minus of the capital expenditure? Okay, so this is a free cash flow in this aspect. Okay. Okay, this is the free cash flow. Okay, where to find this free cash flow data? You just want to, let's say we want to analyze stocks, you want to have a fast overview. Okay, let's say you're on Poems website. Let me just go direct to Poems website to show you how can you know that is a company. Okay, let me just go to stocks. Okay, let me just go to any stocks in Poems, right? Okay, let's see Singapore stocks. Okay, you just go and click like CapitaLand. Okay, you go to stocks analytics. Okay, when everyone can see my this screen. Okay, so this is a fast way for you to have a check. This is just a quick check only. Okay, then just click stocks analytics. Okay, and you're able to see this. This number here. Everyone can see my screen. Okay. And this is trailing 12 months. So it is always based on the last 12 months. So it's rolling on. This number is constantly change every quarter. Okay. So you see that, so CapitaLand is positive, 1.8 billion. Okay. So it is still healthy. So let's just take example of, let's see, SIA. Can you see the cash flow here? How much? -5. It's not -$100, $200. It's -5, and it's 5 billion. Okay, billion. It's not even million. It's -5 billion. So this is what it's called burning cash. They're burning cash now. Okay. Let's look at another company and see what company I can just think of. We just tap. Okay. Keppel Corp. Okay, Keppel Corp, because oil and gas get suffered, they are having a negative cash flow minus 900 million. Okay, but compared to SIA, it's 5 billion. Okay, but then so this is just give you a snapshot on current status. Then you need to look at the past 5-year trend. Okay, Morningstar, you can see the free cash flow for the past 3 years. Okay, Morningstar. Yahoo Finance also can see free cash flow for at least the past 3 years. So you want to see the past 3 years, what is the free cash flow? Is it because only COVID-19 Keppel Corp is negative now? But before COVID, are they positive? Then it's still okay. But even before COVID, if they are negative, then there's something you need to watch out. Okay, so this is how you can look at free cash flow. Okay, in this is just to give a quick overview. Or positive, you no need to worry. Negative, then you need to analyze further already. Okay, is it due to certain condition, or then you look at past track record? How is the free cash flow affected? Okay, so this is one thing you need to take note. Okay, free cash flow. So the cash flow must be positive. Okay, must be positive. Okay, next, you need this number called discount rate. Okay, discount rate. Remember dividend discount model, just a refresher. Dividend DDM model, we want to calculate fair value is what? The dividend plus over 1 plus G divided by R minus G. Okay, I think still remember. I hope everyone still remember. This G is called the growth rate. Right? And growth rate, we all talk about what? We use what? GDP growth as an example. Okay, and R is called the required rate of return. Okay, required rate of return. Is how much required rate of return you want. Okay, you want at an aspect. Okay, in this aspect. Okay, so this is called the required rate of return. Okay, for DD. So for DCF, okay, we want something called discount rate. Discount rate is also something like similar to required rate of return. Is if I were to put my money to buy Apple, okay, if I will put my money to buy Apple, what is the return I should expect to get? Okay, what is the return I should expect to get? Because my money gets stuck in Apple already. Okay, I cannot put it to other place. Okay, so there's two ways of looking at it. There's a conservative way. Textbook way will tell you that, oh, look at what is called risk-free rate. Risk-free rate. If you don't buy Apple, you put in money in Singapore government savings bond, you get you put CPF, you get 2.5%. Then they say the discount rate 2.5%. But I think that one is not applicable when it comes to growth stocks. Okay, I want to buy growth stocks. Of course, I'm not looking at 2.5% already. So 2.5 is really too low. So what is the required rate of return? You see, for me, I want at least 10%. I go and buy a growth stocks. If I say that I only want to look at a discount rate of 3%, 5%, I must go and buy REITs. Okay, because REITs will give me a dividend of 3 to 5% already. Okay, I want to buy growth stock. I want double-digit return. I want double-digit growth because the risk is so much higher. The share price will swing much more. So I want a discount rate is high. So usually I will put 10%. Okay, I put higher rate, 10%. Okay, next, growth rate. Okay, so growth rate is the expected growth of the company in the next 5 to 10 years. Okay, so I buy a growth stock. The company is supposed to grow in the next 5 to 10 years. So how we want to make sure the company is able to grow next to 5 to 10 years? First, the first criteria is I mentioned that the revenue must grow, the income must grow. Okay, of course, if the asset grow is a bonus also, like all three grow. So if they are growing, so the momentum will able to move, make sure that they're able to grow for the next 5 to 10 years because everything is on the uptrend. Okay, and their ROE is also growing. That will definitely this will propel a company to grow for the next 5 to 10 years, but they may grow at a slow rate. Okay, they may grow at a slow rate. That one will come to that later. So it's 5 to 10 years on the growth rate. Okay, and last one is called TV, terminal multiply factor. Okay, what does that mean? Okay, this is just assume that you are buying a company. Okay, you are buying the company stocks now. Okay, and you are looking at to sell off the company 10 years later. Oh, I retire. I don't want to do the business. I sell off. So when I sell, I should get one lump sum back, right? I should get one lump sum back. Okay, I'm not looking at the day-to-day cash flow. I'm looking at one lump sum back. So how much should I get back? Okay, so it's a multiply of the cash flow 10 years later. It's a multiply of the cash flow 10 years later. So this is what I'm looking at. And so the recommended range is between 10 to 15. Okay, 10 to 15. If you are very bullish on this company, even after 10 years, then you can use 15. Yeah, not so bullish. You say maybe 10 years, the company may start to go down here. That's why you want to exit. Okay, then you use 10. So the range is between 10 to 15. Don't put 3, 4, 5. That's a bit too low. That usually not for growth stocks. Okay, so 10 to 15. So this is the number you are looking at. Okay, when you come to doing a growth stock analysis. So these are the key parameter you need to look at. Okay, when you do a growth stock analysis. Okay, so now how to get all this number in? Let me just go back to the Excel file. Okay, I have the, okay, so the growth rate. So the growth rate, how much should I use? Is I use the same growth rate. Okay, under the Yahoo Finance. Okay, well, Yahoo Finance give me growth rate. Poems don't give me the growth rate. Okay, under the Yahoo Finance side, right? Under analyst, okay, I can see the growth is here. Okay, I can see the growth rate is, I use this to calculate PEG also. Okay, it's 12.72. The past 5 year Apple only grew at 8.42. Okay, past 5 year, this is confirmed already because this is already over. So they project from now moving forward, Apple should even grow better than the past 5 years. Okay, this is what analysts are very bullish on Apple for the next 5 years compared to the past. That means they foreseen Apple will able to go faster. Okay, which I also think so. Okay, we also think Apple should be able to go faster for the next 5 years. So you can use the 12.72, but do take note, this is only 5 years. Okay, this is only 5 years. And you want to be more conservative, I don't assume the growth rate for the next 10 years to be constant. I assume that Apple will grow at 12%, 12.7%, because this is what most analysts estimate in the next 5 years. But what about next 5 years? I'll presume their growth should come down already. A company, they grow so fast, I don't think they can perpetually continue to do 12% forever. Okay, I think they may time to slow down. So what you can do is you can even use half the rate. You can just take half the rate off. Okay, 6%. Okay, this is more conservative. If you do 12%, of course, that's the best. But you just be a more conservative, take half it, because that is too far away for you to predict. So when it's too far away to predict, always think for the worst case or more conservative case. So take the growth rate as lower. So take it as lesser. So 6%. Okay. So discount rate, I take it as 10%. Okay, I take it at 10%. And terminal value, I take it as 15. Okay, I take it at 15. I think, okay, if you feel that, oh no, Apple, I don't think 10 years later is still very strong, I want to put 10. You can also do it at 10. Okay. So it's a range of between 10 to 15. So if let's say I put it at 15. Okay. So what are the other data I need? I need to find free cash flow. What is the current free cash flow for Apple? And I want to know the net cash for Apple. Where to find this? Okay. Where to find this data? I just go. So now I just get everything from Yahoo Finance. Okay. You go to here under the finance portion, under the finance tab. Under the finance tab, you click on the cash flow. Click on the cash flow. Poems also have this. Okay. But one thing about Good is they calculate for you the free cash flow. They calculate for you already. Then operating cash flow minus capital expenditure. Okay, so they calculate for you the free cash flow, and it give you how many years of comparison? 1, 2, 3, 4 for your comparison. So you can see Apple cash flow is very strong. It have 50 billion, 64, then it dropped to 58, then it go up to 73. Okay, now I use a trailing 12 month is 71 billion. So Apple now have a free cash flow of 71 billion. Okay, so it's not million, it's billion, 71 billion of free cash flow. Okay, our Capital Land is considered a very big company in Singapore, right? Have cash flow is only 1.8 billion. Okay, so you can see a giant and a dwarf when come to different market expect. Okay, so when come to US market, you have to think bigger number, add a few more zeros to the numbers. Okay, so free cash flow is 71 billion. What I need to do, I just need to copy this data. Okay, I put it here 71.6 billion. Okay. Next, I want to do this thing called net cash. I want to know that how much cash actually Apple have. Okay, after minus of their debt. Okay, what do you mean by net cash? Net cash means I want to see the cash at bank. Okay, at bank minus of debt equal to how much? Okay, so that's called net cash. The cash at bank, okay, or cash and short-term investment per se, minus of their debt. Okay, how much money does Apple have? Okay, practically it means that if it's positive means what? It can be a debt-free company. Okay, it can be a debt-free company. Okay, so that is how I want to find it. And where can I find it here? You just look at statistics. You click on this statistics. Okay, you click on the statistics. Okay, you don't like Yahoo Finance, you can go Morningstar. They should have all this data also. Okay, you click on this statistics and you go all the way down. Okay, all the way down is total cash. Okay, total cash Apple at how much? 90 billion. Okay, but their total debt is 122. So it's negative. So it's negative. So it is negative. Okay, it is not positive for Apple. So it's 90 minus 122. So what you need to do is, okay, so that means they leverage, they actually have leverage in the aspect. Okay, so you just put 90 minus 122. Okay, will give you a negative value. Okay, it is okay to be negative. Okay, it is okay to be negative. Do think no, that's why I put net cash or net debt. Okay, it's okay to be negative. Okay, when come to this type of analysis. Okay, because ultimately we want to see, because the company is making money, the company is growing. Okay, it's just that their debt is more than the cash flow. Okay, most of the company listed company in Singapore, okay, are negative one. Their net cash minus their debt. Okay, certain company net cash is positive one, like Yang Zijiang, they got a lot of debt, but I think their money in the bank is more than their debt. Okay, for them is net cash is positive. Okay, for them net cash is positive. Okay, but Sheng Siong definitely net cash is positive because they don't have much debt. But look at CapitaLand. Okay, look at Fraser Property. They definitely is negative because they are asset rich company. They got a lot of borrowings. Okay, so it is perfectly okay to have negative. Okay, this perfectly okay to have negative data. Okay, so by inputting all this number here, this one, I actually preset the formula here. It already calculate for you already, and I didn't block it. So if you want to see where this number come from, it is always show here. Okay, so it talk about the cash flow. Okay, let me just explain how this works. So the cash flow is 71.6 million is here. Okay, but I discount it to present value, become 65 lah. Okay, I make it back to present value. Okay, because 1 year time frame. You talk about 1 year later. Okay, 1 year later. Okay, because we're now from 0, then we go to 1. And it become 81. Why you go 81? Okay, why the free cash flow will become 81? As it will grow. I based on grow at 12.7%. So the cash flow will definitely grow. Okay, and up to the 6th year, the growth rate will drop to 6%. Okay, the growth rate will drop to 6%. So you can see the formula here. Okay, the growth rate will drop to 6%, and that's how you do the calculation. And I'll bring down the present value. So at the end of 10 year, the free cash flow is 155 billion, but I bring the present value actually is only 60 billion. Okay, it's actually less than current. It's less than current. Okay, because I have a discount rate at 10%, and the future growth is only 6%. So you can see the present value actually is lesser. But at that point of time, I want to terminate the business. I want to cash out on business. So I need to add in this multiply factor 15 in. So it's really become 2320. Okay, the future cash flow. Okay, this 155 I multiply at 15, so it becomes 2320, and I discount it back to current. Okay, so this is for those that if you don't get it, the formula, do let me know. Okay, this is how this formula works. And present value of future cash flow now become 1.5 billion. Okay, 1.5 billion. Okay, so this is the cash flow of the thing. Okay, and okay, how I get this number, and that what is the fair value here? Okay, fair value here is I need to add in the net cash now. Okay, I need to add in the net cash of this fair value. So this is net cash negative, so the fair value become 1.529 billion. So this is the cash flow. Okay, this is a value of this company now. Okay, so some people say how to value Apple. Okay, this is a value 1.5 trillion. Okay, 1.5 trillion. Okay, this is how Apple is valued, but the market cap is 2.15 lah. Okay, and what is the fair value for Apple? So I need to take this fair value, okay, divided by the number of shares outstanding. Okay, 2.4. Okay, for Apple, I think the data is a bit haywire. Okay, the data is a bit haywire. Okay, maybe I explain to you why the data is heavy. The fair value is the number of shares outstanding is 2.4 trillion. Okay, number of shares outstanding is 2.4 trillion, and the fair value for Apple is 636. What is current Apple price now? Okay, it's actually only 126. Okay, why this value is a bit out and is out, you can see it's completely out, is Apple have a share split. Okay, few months ago. And do think that this is quarterly reporting data. Okay, so the data is not really synced yet in this aspect. Okay, so there is a share split, and thus the data a bit haywire for Apple. Okay, so thus you get 636. Okay, 636 for Apple. Let's say I were to divide, I think it's 4-1, right? If I'm not wrong, the share value become 159, and now it's 126. Okay, is it 4-1? I cannot remember. So we just need to make it more accurate. It just need to divide by the recent share split. I think it's a few months ago. I think last month. Okay, and Apple is currently still a bit undervalued. Okay, it's still undervalued. So that is how you do the analysis on the growth stocks. Okay. So far, anyone got any question on this aspect? Okay. Yeah, Apple is a 4-1 split. So you need to adjust. But maybe after one more quarter, then look at Apple, then the reading will be later updated because the quarterly report, all this will factor in the share split already. Okay, factor in all the share split, all these things, then the data will be more accurate on this aspect. Okay, so let me just use this formula to look at another growth stocks, Facebook. Okay, so let's look at Facebook. Okay, okay, so this is Facebook in this aspect. Okay, so what is the criteria first? Okay, I need to go back again on the criteria for a growth stock. When you, before you do all this calculation, when you want to do a growth stock calculation, the checkpoint is the first checkpoint, you must look at market cap. Okay, must be big. Okay, must be big. Okay, this is 750 billion. We are looking at 100 billion, so it definitely pass. Okay, revenue must go up, profit must go up. Okay, return equity must be high. Facebook, if I know, is 24%. So if everything, then from here, it look okay, then you go further down to analyze. Okay, if the revenue, all this is no good, everything come down, then you don't go and waste your time to look at cash flow idea. Okay, don't go and waste your time to analyze further. Okay, so that is how you look into this aspect. Okay, this is more like okay, investment, there's always risk, but you just want to mitigate your risk to the bare minimum. Can mitigate the lower the better. So you want to be very strict, you must check, make sure everything pass. If one of the things fail, you say you don't want to buy. Okay, then you don't want to buy. But put it that way, if we are very strict, we have to be very practical. So you are very strict. If everything must pass, then you buy. Sometimes you may have no stocks to buy. Sometimes you may have no stocks to buy. Well, if everything must pass, then you buy. Most of the time, when you put in this type of rate, you put in even more conservative rate. the price will be even very much lower than the market price, and sometimes it may never hit. Okay, so this is something you need to take note. So there's always some give and take when you do the analysis for growth stocks, okay, or even for dividend discount model stocks, okay, because it is still what you want. You put a discount rate of 10%. If I put a discount rate of 15%, Facebook must drop to 207. Facebook must drop to 207. Okay, then I buy. If I give a discount rate of 10%, okay, 10% is the minimum. Facebook go 289. Now the price is 263. Can buy Facebook. Okay, so that is what we mean by your data. Growth rate is given, okay, by analysts. Okay, let me just go back to here. Okay, and also there is something you need to take note. Let's look at Facebook. Okay, let's just use Facebook as an example. I would think I will not go through to look at what is called current ratio, interest cover ratio. All this, I think you can look at it on your own. You go more straight to how to get all this number, more critical number in. Okay, when you look at Facebook by itself, okay, you see that Facebook is 263 now. The market cap is 715 billion. Okay, it is a very big company. Okay, the PEG is 1.7. Okay, PEG is 1.7. Definitely is on the high side. Okay, all tech stocks, I think you can't find PEG less than 1 at current market juncture. So we need to be practical. The P is 30, or the P is 30. Okay, so that is on the Facebook aspect. And the cash is 55 billion, but look at their debt is only 11 billion. So what does that mean? Facebook compared to Apple, they are in the way called debt-free company. Indirectly, they are called debt-free company because the money in their bank is more than the debt. Money in the bank is more than that by more than 4 times. By more than 4 times, 5 times, actually 5 times. Okay, so their debt is become unnecessary. Okay, they just take some debt. Okay, so that is what Facebook is, a bit different from Apple. Some of them will like, I like positive net cash company. So you can set your criteria. You say, I only look for net cash positive one. Okay, I don't like to have net cash negative one. Then for the case Apple, you not even want to look at it because it's negative. Okay, but to me that one is not critical. To me personally, I don't think that is a very critical thing, but it's up to you to set the criteria. So for Facebook, definitely is positive. Okay, so it's about 44 billion positive. Okay, so that's on the Facebook aspect. So what will be the growth rate for Facebook? You go to analysis. Okay, and they go even more analysts looking at it, 40, 40 analysts looking at it. And the growth rate is actually, but you can see a bit different for Facebook compared to Apple. Apple here is single digit, right? The past 5 years is lower, the projected is higher, right? Analysts are more bullish to Apple, but analysts are less bullish to Facebook. They expect Facebook to grow, to slow down. Okay, they expect the growth of Facebook to slow down already. Actually, it slowed down a lot, 42% to 16%. Okay, but it's still a double-digit growth for Facebook. Okay, for the next 5 years. Okay, 16.6%. So that is what analysts are looking at Facebook in this aspect. Okay, what about the free cash flow for Facebook? Under the finance tab, okay, you go to cash flow, and it's 23 billion. And you look at the past, it is 17, 15, 21, and 23. Okay, so it's a positive cash flow. If you are conservative, okay, for me, I will just take the trading 12-month one. Okay, some of them say, no, I don't take the trading 12-month, I take the average. Okay, because average is lower lah. Okay, I will just take the latest update, 23 billion. So that is what I'll take for this aspect. And the share outstanding, if I'm not, is 2.4 trillion. Okay, number of shares in the market for Facebook is about 2 over trillion. Okay, 2 over trillion for Facebook. Then from there, you key in the calculator. Okay, how much would you get? It's 2.4 billion. Okay, this is the number of shares outstanding. You may ask me where to get. Okay, it's under the share statistics. Okay, it's 2.4 billion. Okay, so then you go inside here. I key in all this data, 16.6, a discount rate maybe 8%. okay, half of it in future, okay, for Facebook expect, and the fair value become 272, okay, Facebook 263. So means that Facebook now the value currently is quite on a fair value based on discount the discount cash flow model. Okay, so this is on Facebook aspect. Okay, so this is the number aspect. Okay, when come to grow company. Okay, and okay, this is more looking at numbers. This is more looking at numbers aspect. Okay, there's always quantitative analysis and qualitative analysis. Okay, but do take note, this number is just a number that you input in. Okay, you input in, and it based on analyst estimate. Okay, analyst estimate. Okay, and a lot of people say do not trust analysts. Okay, do not trust analysts, but it is 30, 40 analysts, and they are taking the average of analysts. So I think it's still okay. But if the company only have one analyst or two analysts, then you may really need to look further. Okay, look further on this aspect. Okay, whether would there be a future for this company? Okay, so and next part is this is just looking at numbers. The next portion you need to look at the company futures. Okay, what do you think of this company? Okay, what do you think of the company futures? Okay, there is no right or wrong. There's no right or wrong in looking at that. Okay, when talk about Facebook, some people say, oh, Facebook got a lot, it's a more monopoly, got a lot of potential to grow. Okay, can you name a competitor for Facebook? Okay, currently any known competitor you know that can come in and compete with Facebook in the market. Okay. I currently think of any really strong people that come in can compete with Facebook. Okay. We don't talk about China company. Okay. China company. Okay. Because we are talking about US. They are completely different thing because they are fighting against one another. So look at globally US aspect. Is there a competitor for Facebook? Okay. So that is something like, okay, probably TikTok. Okay. Probably yes. Okay. But so but if for TikTok to really catch up with Facebook, okay, yeah, for TikTok to really catch up with Facebook, I think it may take years. Okay, it may take years. So if there is no competitor, okay, for Facebook, right? So that's the analysis. Look at, okay, then Facebook indirectly is a monopoly. So in a monopoly, so then definitely you will definitely grow for until the competitor come out. Okay, until the competitor come out. So what you want to do is you want to buy at a price that is you think is reasonable for you to buy Facebook. Okay, but then you need to understand the risk of Facebook. Okay, what is the risk of Facebook? Because they are growing too strong. So it become very political. Very political. Okay, you may heard of news that US want to chop off Facebook. Okay, okay, want to dissect Facebook because Facebook become too big. They want to they even the court want to cut Facebook into smaller pieces. Okay, small pieces. So we got client told me that like Facebook got danger now because they're going to be cut into smaller pieces. Then the share price would, if the law will pass, force Facebook to be chopped into smaller company, then will it affect Facebook share price? Okay, then you need to look at this thing. It is possible or not? Okay, that is US. You told me Facebook is a China company. I say it's possible because China government want to chop anything they can do. Okay, they can stop. And I mentioned it now, Ma Yinggo MIA. So it's possible. But when it comes to US, okay, if they're going to chop Facebook, they need to chop Google. Would they going to need to chop Amazon also? Okay, so what is the ripple effect? They cannot just chop Facebook only, ma. So if they want to chop Facebook, they need to chop Google. All the big company all will get chopped to smaller pieces. Okay, to small pieces. Then in that case, US is a free economy. Then which company want to grow? Okay, the negative effect is very strong. Which company want to grow? So it is not practical for them, although they talk only, but to actually execute to chop Facebook, I think We cannot say never, it will never happen, but I think the possibility is very slim. Possibly, that's my view on that. Thus, I feel that growth stock aspect, Facebook definitely got a good potential in the aspect. Okay, so same thing for Apple. So is there a competitor for Apple? Okay, so that's one you look at it. So globally, of course, some people look at Samsung, China company. China company, I think to compare Apple, they may have some challenges. Okay, but Korea, Samsung, but I think Apple will still lead the way for the next 5 years at least in the near term. You are not buying a stocks that are looking to grow for perpetually forever and forever. Okay. Very hard to find a company that is able to grow forever. So you want to look at a company at least for the next 5 years, it still be the dominant player. It may not be the key main only player, but it must be the dominant player. Okay. How to do that? Okay. How to eliminate, how to reduce your risk of that is market cap. Okay, so that is why the market cap come in. Okay, the market capitalization come in. If the company is too big or very big, okay, it is very big, then the probability of they able to last for the next 5 to 10 years is very high. Okay, it's very high. But of course, you don't expect them to have exponential growth, or you don't expect them to have exponential growth. Okay, but you know that definitely the company will be there. Okay, will be there for you. Okay, and the return will definitely will be good because they are more towards the growth sector. It's still double digit, but you should not expect a 10 bagger, that type of thing. You shouldn't unlikely Facebook $263 to become $2,630. Okay, in next 10 years. It may be possible, but I think the chance is very slim. Okay, you should not expect them to become $2,000 over dollars. Okay, okay, but at least they go to $300-400. It may still possible. Okay, it may still possible for Facebook and aspect. So we are looking in this aspect. Okay, when it comes to growth stocks aspect. Okay, so this is where I want to look at. So Drew is buy big company. Okay, later on towards the end, I'll wrap up and talk about what are the company you can look into it. Okay, so this is just some example. But before we go for a break, maybe I just want to talk about, yesterday I talk about these two company. I don't know anyone go and look at this company. Okay, called Riot. It really go Riot. Okay, you really go on Riot in the stock market. Okay, this is someone that, okay, this is not for a long term. Okay, this is not for a long term. This is if you are looking at, if you are very positive on Bitcoin, you are very positive on Bitcoin, okay, and you don't want to buy Bitcoin, okay, actually, perhaps you can't buy Bitcoin also. I also cannot ask you to buy Bitcoin because it's not a licensed product, but it can buy stocks that is directly linked to Bitcoin or crypto, directly linked to cryptocurrency, okay. So what does Riot Blockchain do? Their main business is just to set up mining company, set up mining machine to to mine out Bitcoin, to produce Bitcoin, okay, to produce cryptocurrency. So that is their job. So they are, but do take note of the risk. $19, it look big to us when it comes to Singapore stocks. $19 in US is considered penny. Okay, slightly less than penny is equivalent to Singapore being 20 cent stocks. Okay, in that equivalent to stocks in Singapore that's listed as 20 cent. Okay, so that's something you need to take note. It's equivalent as penny. Okay, and this type of company, as I mentioned, we don't look for, you can see that as the market cap 1.3 billion. Okay, if you use the Singapore standard of 500 million, you buy this company. Okay, but we thought we want to look at 100 billion one. Okay, so definitely this is not in the aspect, but this is for those that you feel that a bit too boring in, okay, you want to have some excitement. This is something for you to this is just something to share for you to take a look. Okay, in this aspect. Okay, yes, 6-man show, Boon Hua, correct. Well, you're very fast. Why I like blockchain, you can see you go down. You scroll down this this rate, okay, you scroll down, where's the thing, under the summary, under the summary, you scroll down, so can you imagine, a listed company in US only have six staff, only have 6 people, and this company worth 1.3 billion. So sometimes US market is a bit crazy, okay. So US market is a bit crazy, okay. So let me show you how does this share price move. This is you can see the chart. Okay, you can see the chart. 1926, okay, and this is a share price. So it really how many percent return, okay, you go into buy these stocks, okay. But do think no, you have a weak up, please don't try this type of stocks. You may get burned very, very badly one. Okay, the 52 weeks range is 50 cents. Remember, it's 50 cents. So in Singapore, it's 0.005 cents. It grew to $19-20 in 1 year. Okay, in 1 year. I think this growth is more than Tesla. Okay. Okay, so this is what we mean by blockchain. Okay, this company got no fundamental, so you cannot use a cash flow method, all these things to analyze. You look at the company fundamental, practically it's a losing money company. Okay, you can look at the income statement. Okay, they still got some gross profit. Okay, gross profit. What is our net profit? Okay, the net profit is negative one. Okay, it's a loss-making company. It's a loss-making company, but you buy that share, you make tons of profit. Okay, so this type of company is not there for you to buy for long term. Let me show you another company. Yesterday I showed this company called Mara. Okay, it's a competitor to Riot. Okay, it is a 1 billion over company also, and it only have 3 employees. Okay, yesterday night I mentioned yes. Okay, 24% one day. Okay, so but do take note, this type of company is penny stocks. It can be a, we call a pump and dump company. Okay, it can be a pump and dump company. As I mentioned, it's only $1 billion, so the price can be manipulated. Manipulated means what? You buy already. Okay, everyone tell you to buy. After that, it can plunge. Okay, it can plunge like nobody business. Let me show you what do my plunge like nobody business. This is another company. Okay, let's say down 5%. Is $63. Okay, it called QS. Some of you may heard of this company. Okay, it also from nobody $9.37, $9.74. Okay, go up to $132. $9, $132. Okay, but now what's the price? 63. Okay, so if you are someone that buy at 132 here, which is actually only when only it's only December only, you have a 50% loss. Okay, you have a 50%. So these are what I call a backdoor entry company. So when you buy growth stocks or US stocks, okay, so since to take note of that, since to be very careful on this type of stocks, okay. So because this is what happening in US market now, so you don't go and buy company that is too small. Okay, this one is 21 billion. Okay, but it's still lower than our criteria, okay, of 21 billion. Okay, it's still pretty small. Okay, didn't even declare how many employees there. Okay, these are called backdoor entry stocks. Okay, this is called a backdoor entry stocks. What do you mean? You know, like US currently got a lot of empty shell company. Some of you may heard of. Okay, so they go and buy out this company and get this company listed. Okay, so this is what this company come about. Okay, it was being bought over by an empty shell listed company and become listed. And then, so a lot of speculation play inside. They just come out with one news. This company do what? Battery. I think this company do battery. And Apple say that they're going to work with him to do battery. Because of Apple say news say that Apple going to work with him to do battery, the share price shoot all the way to $132. But do take note, this is called price move due to speculation. Right? But the material, the really thing the battery really to come out is 2025, which is 5 years later. So it's not current. So this is something to think of. So Apple say going to work with them for do battery, but the battery only come out 5 years later. So the share price move up now already. Okay. And so after everyone realize, hey, it's not now. So dumb down 50% loss. So a lot of smart money inside. So just to be careful. Okay. So when it comes to US market, there's a lot of distraction. Okay. So this is just something that you need to take note. Don't be driven by greed. Okay. Some guy, Apple didn't say, some guy in YouTube speculate, and so this is what happened in US. So don't look at $63 is a big company. Actually, it's not. 63 equivalent to Singapore company is about 60-cent company. It's a 60-cent company. Okay, so this is something to take note. Okay, so now it's about 9 o'clock. Okay, we will take a short break. Okay, we will take a short break, and so there's one question I need to answer first. Okay, when to sell a company? Okay, when you let go. Okay, so this is something that when you look for growth stocks, okay, there is no, okay, not even growth stock. Okay, buying is very easy. Yeah. Okay, when to buy is definitely very easy. Everyone will know. Let's press button to buy only. Okay, so the part is come to selling. When to sell the company? Okay, if you talk to a value investor, okay, they'll tell you they'll hold forever. Okay, they'll hold forever until it become what? Overvalued. Until it become overvalued, then they sell. Okay, so that's one thing. Until it become overvalued, then they sell. Okay, so but that's on theory. That's on theory. Until they become overvalued. Okay, or when there is a fundamental change in the company. Fundamental change. What do you mean by fundamental change? We use CDI as an example. Okay. There is a board shake-up in CDL now. Okay. So whether you think it's a good or bad, okay, you think it's a bad, then maybe there's a time you should exit CDL. But I think it's a good move, then maybe there's a time you should buy CDL. So that's called some changes. Management change or fundamental change, the company direction start to change. That there's company that maybe focus on this business. Okay, they are very good in doing this business. For example, they are very good in doing semicon business. Then suddenly the CEO start to diversify, go into a property business, go into what education business. Okay, that means the company have start to lose focus on what they are doing, and that's the time that you should sell the company also. Okay, so that is when you should sell. Okay, the other thing you should sell is when you feel that the profit is good enough for you. Okay, the profit is good enough for you. Okay, so that is the first part. Okay, and okay, there's two ways you can look at it. One, some people look at profit based on percentage. Profit based on percentage. Okay, profit based on percentage. What should you sell? Okay, the other one is some of them will based on technical chart, technical analysis chart. When you go to overbought at that time, then you want to let go. Okay, or when you want to overbought, or some of them will use the trailing method. Okay, that means they make a very good profit already. They see the profit keep on go up. But there's some bad news come to the market. There is a dip in the price. They will exit. So whichever method is depend on individual. Okay, so whichever method is depend on individual. So there is no right or way. Okay, it's just that it's never wrong to take profit. It is never wrong to take profit. Okay, it is never wrong to take profit. Money in the pocket is always safer than money in the market. Okay, it is never wrong to take profit. So when you buy in the stock at that time, you have to tell yourself when you want to sell. You have to tell yourself, set your criteria when you want to sell. Okay, I just use my example. Okay, if I were to buy a dividend stocks, the focus is for dividend. Okay, the focus is for dividend. I will only sell the stocks, consider to sell the stocks when the profit costs 40%. Okay, when the profit costs 40%, then I want to consider to sell the stocks. But I may not sell 100% of stock. I may just sell half. I take out the money because I want the capital gain out also. Okay, I want the capital gain out also so that I can redeploy the capital to get more dividends. Okay, to get more dividends. So that is one way I look into that. Okay, when I buy unit trust, okay, for dividend unit trust, I will sell the unit trust 50% unit trust when I make a 30% gain. When I make a 30% gain, okay, then I still continue reinvest in that unit trust again. So that is my side. But when it comes to growth stocks, okay, I will usually sell in batches. I will sell in batches. Let's say I buy a growth stocks. For example, let's say I buy Tesla. When I see Tesla make 30% profit, I'll take out 1/3. Nobody know Tesla will go become so high. Nobody know. But I take out 1/3. When it cross the next hurdle, let's say 60, 70, I think I want that. Then the last portion I let it run forever. Okay, so that is how I look at it. Okay. Okay, so this is how I look at it. For example, I also speculate in certain stocks. For example, the Riot, the stocks are now sitting on 50% profit, but still not selling. Well, it's only a small amount, a small capital to put in just to have the feel of how people speculate stocks in the market, in the US market. Okay, so that's how I look at it. Okay. And okay, so now we're going to take a short break. Okay, now it's 9:11 already. Okay, today I think so we're going to take a short break and we come back at 9:20. Okay, we come back at 9:20. I think okay. Then we'll start the second part. Okay. You all got any question? You can just type in the chat box.